Hey, how's it going, guys? Filthy Quant here. I got my third guest from an investment bank. He is a quantitative developer. You want to start us off by talking about what that involves, what that job is?
Right. Before I start, I just want to thank my host for today. Thank you so much for having me. Um, Never done this before. Just a disclaimer. So just so that you guys know. Right. So, what does my role entail? So, I work in the electronic market making team for FX Spot, and
Okay.
I work for an investment bank that's part of the Bulge Bank, I think, as it's known as.
Okay.
Um, and what we do is we electronically market make FX spots, precious metals, and US treasuries. Um, for those of you who do not know what market making is, it's essentially providing liquidity to the market. So, for example, if you go to Tesco to buy potatoes, and you have these different vendors that provide potatoes to you, we are one of those Tesco outlets, so to speak, where you can come and buy potatoes from us, but you can also buy tomatoes, you can also buy different vegetables and so on. So now sort of bringing back to what I do, we provide liquidity or we provide these different currencies in the market. So different institutional investors, pension funds, hedge funds, and so on and so forth, they can come to us. They can tell us that we want to buy a certain amount of a currency, say a million um, euros for USD, and we tell them for a million euros, this is what you need to pay us. And if you buy a certain, so for example, if you buy 2 million, this is what you're gonna pay us, and so on and so forth. So this is known as market making, and we do that electronically, which means that we have a trading platform that we run, build, that does all of that. So it sort of goes to these different markets that are available, looks at the liquidity, comes up with its own price that we need to sort of spit out to our clients. For different liquidity that they want to buy from us, we spit out different prices depending on a lot of different other factors. If they're a good client, bad client, how much they trade with us, and so on and so forth. And once they've traded with us, we have a certain position. For example, they trade Euro USD with us, so we are say for example they're long euros, so we are short euros, and so on and so forth. So once we have a certain position, we just determine whether we want to hedge it out to the market, just hold on to the risk, and so on.
Yeah.
I mean, I can go more in depth, but I don't think this podcast is about that.
So there's quite a lot of interesting things there so I see a lot of things on TikTok about like retail traders. They always talk about market makers. They always talk about the banks pushing down prices and pushing up prices.
Yeah.
So maybe we can touch on that in a bit later.
Yeah.
But I just wanted to like dive into a bit more about what market making actually is, because like I remember when I was first starting out in retail, it was extremely confusing.
Right.
So like from my perspective, I think the easiest way, I think you described it in a really good way with the Tesco's example.
Yeah.
So like the way I like to think about it is very similar. It's just kind of like you have suppliers, right? And when you get a quote from your supplier, you get like tiered responses depending on how much you're buying.
Right.
That's all market making is, right?
Exactly. So we're just sort of, because the thing is, the primary asset class we deal with is FX spot.
Yeah.
And as your probably listeners or watchers know,
I'm sure
that
there's some forex traders out there.
yeah, they know it's a very, very liquid market.
Yeah.
Which means it's moving really, really fast, and every second you have different prices, new prices, and so you can only sort of trade this electronically.
Yeah.
If it makes sense. We do have some voice traders, but the business of been dwindling for them, and if anything, it's probably gonna get cut off even more.
Yeah.
So because it's so liquid and moves so fast, you need to constantly do it electronically and looking at new prices, see what's the liquidity available at different venues,
Yeah.
see what's the best price. We have something known as a primary market, fast market, and so on.
Yeah. Yeah.
But that's pretty much it.
Yeah. So like I think one of the biggest misconceptions I hear a lot on TikTok retail traders is, one, they don't trade spot, because you can't trade spot forex in retail.
Yeah.
You're trading a CFD, right?
Yeah.
But those CFD brokers are like a small portion of the total institutional volume, because they're hedging out that traffic they're getting from retail, right?
Right.
And they're not plugged into the interbank market.
Yep.
They're like a tiny little portion of volume that they get from the interbank market.
Yeah.
So they're not even part of the FX system. If that makes sense.
Yeah.
But there's a really common misconception among retail traders that banks and market makers will move the market to stop them out of their positions and hit their stop losses or whatever. Is that something you've heard before or come across before?
I guess, I mean, I can only tell from the perspective of the business that I am in, FX Spot, and as you said, because FX Spot is mainly dealing with institutional clients. I definitely don't see it in my asset class.
Yeah.
Because we don't have as much retail investors anyway, and also given how you have these market regulations now, you have first look and so on and so forth. It just becomes really tough for people to be market manipulating it.
Yeah.
It's really easy sort of to sit and be like, you know what, maybe this bank somewhere, sitting in an ivory tower is manufacturing prices and manipulating stuff. But it's not that easy.
Yeah, if you think about the size of the market as well, think about the volume you would
Exactly. And we are one of the
that.
biggest banks in the world, and the percentage of market share we have is tiny. And given how fragmented the markets become, because what happened with, you have Robinhood in US, and you have, I don't know what's the equivalent in UK, but you have, these new platforms that are coming up, especially in emerging markets. I know a few examples in India.
Yeah.
It becomes so easy for people to sort of get in and trade. The markets become really fragmented, and so you used to have these really high market barriers to get in, where they would have to pay these high amounts to sort of get into and be part of the interbank market and all. And even though right now, if you're not a bulge mark, you can't be part of these interbank markets, but you can still get a really close liquidity and prices available. So it's really tough to market manipulate.
Yeah, like even if you think about it from like a business point of view, the amount of money you would need to source from your clients in order to push prices up or down is insane.
It's absolutely ridiculous. Yeah.
And if you think about the hedging risk of actually wanting to do that as well.
Exactly, yeah. And just so the readers of know, the way we make money as market makers is by making money on the spreads. Yeah. So the clients will buy from us at a particular rate, and we usually the way we sort of go about it is we do something known as internalization, which means we hold on to the risk. So for example,
that's if you don't hedge it out, right?
Yeah. So the idea is, if you hedge it out, we're gonna make a loss.
Yeah.
Because the price at which we are market. So the way this works is, for example, this is the spread that's available.
Yeah.
I don't know if the people can sort of see, but for example, the spread's 10 centimeter wide between the buy and the sell side.
So the bid offer spread.
The bid and the offer. And if we were to sort of go and trade with these sort of margins with our clients, they won't trade with us, because you have better rates available with other clients.
Yeah.
So the way we work is we work within that, which means that our bids and the offers are less than what's available in the interbank market.
Yeah.
And that's the way we are competitive, and that's the way we make money. But now that we have traded with that, if we go out to the market and hedge at the wider the spread that's available in the interbank market, we are going to make a loss.
Yeah.
Hopefully that makes sense to the listeners.
Yeah, so like, how can we describe this in terms of our Tesco's example? So like I guess you can think of like a bid offer spread on market making. Like, again, going back to sourcing things from your supplier. If you're a Tesco's and you're sourcing your produce or whatever from a supplier, they're going to give you a price based on how much you're buying, and that price is going to be more than what it takes for them to produce that product, right? That's how they are making money.
Yeah.
So in this essence, their suppliers are the market makers, and they make a spread, and you guys can basically lock in that spread. That's your profit. But if you go off and try and hedge it in the rest of the market, you make a loss.
Yes. The host has explained that really well. The way this works is we internalize it and we sort of lock in that price. And if we go out and hedge immediately in the interbank market, we're gonna get screwed over, because our spreads are gonna be wider. We're gonna make a loss, and then it does not really make sense to be in this business. Yeah. The way this works is, for example, client A bought euros from us, say €1 million. Other client, wants to sell euros to us, 500 million. So instead of this being two different trades, we try to reconcile it, and so the net sort of becomes 500 mil up or long for us, and so on. And so we sort of do this over the entire day, and unless we hit certain particular limits that we have, that the bank specify that only we can hold this much risk for a particular currency. For example, we hit 500 million where no one's sort of going long or going short, and we hit that limit. We're like, okay, fine, now we're gonna hedge out and make a loss, because holding on to this position is really, really risky for our bank.
Yeah.
But otherwise, we are sort of always trying to hedge and internalize it. So this trade balanced out with that trade, and so on and so forth.
Yeah. So going back to that like supplier example, it would be like, you don't want to make a loss on your sale. So like if you're selling to Tesco's and you want to collect that spread, you don't want to sell it for less than what it costs you to make it. You do have the ability to hedge that risk by going out to other suppliers in the market and buying potatoes for less money than it costs you.
Yeah.
If that makes sense. That's probably a bit complicated now.
It's complicated. I'm just thinking, if there's a whiteboard whiteboard.
A whiteboard we can use here. But basically, like if you're a supplier and you want to sell to Tesco's, you can either sell it at your profit margin, or you can buy them from someone that's cheaper and hedge out your own risk for whatever potential market forces might affect the price of those potatoes.
Yeah.
But if the other people in the market are selling at a higher price than what you are selling to Tesco's, you're going to make a loss if you try and hedge it. Is that probably a good way of putting it? It's a really complicated topic, guys.
To be honest, it sort of sounds complicated because maybe if listeners are listening to the idea for the first time and unfamiliar, it sort of sounds complicated. But honestly, if you're in the business and you sort of think about it a bit more, it sort of makes sense.
Yeah.
Essentially, we're trying to price within the spread, and if you go to a market and spread at a price at a wider, we're gonna make a loss. So we try to sort of keep it in and balance it out with other trades. That's how we make money.
Yeah, it's all in spreads.
Yeah.
And so kind of going back to the retail aspect of it, just to kind of reiterate, you guys don't see any data of what retail traders are doing, right?
Nope.
Like it's I'm pretty sure it's illegal, right?
Yeah.
Like,
so
it's impossible.
I mean, we have some client information from the different clients, but we are doing some analysis on that and seeing what clients are doing well, what clients are not doing well.
These are institutional clients, and it's total net flow, right? You don't see individual positions and stop losses or whatever they're doing.
No, not at all. So those information is completely I can't remember the word for it, but we don't really have access to any of that. And would be within. I don't think that'll be legal to sort of look at individual client trades and make decisions like that.
Yeah, so like the thing I hear a lot on social media around retail trading and FX is that, and this happens a lot because people will put on trades with their CFD broker and they get stopped out all the time because, one, they're trading on leverage, but also because CFD brokers, again, they're trading on this spread that we spoke about, where that's how your broker makes money, is they'll sell you this CFD contract that tracks the US dollar or Euro GBP or whatever it is. And they make money by charging you a slight spread on what the actual quoted market price is. Mm-hmm. When you buy it, you eat that spread. That's what your broker is making. But in CFD markets in the UK, and this is why it's banned in so many countries, CFD trading, is that you can have floating spreads. So your CFD broker will increase the spread in volatile moments, and that's what stops out a lot of these retail traders. So it's not the actual market price in real life that a lot of retail traders think it is. It's not these market makers that are trying to stop you out. It's your CFD broker because they have these floating spreads, if that makes sense.
Yeah.
And so there's a misconception a lot on financial TikTok online that, it's your market makers, this evil bank in this ivory tower, like you said, that are like manipulating. But it's your CFD brokers. And it's completely legal because it's a derivative contract, but it's regulated like a gambling association would be.
Right, okay.
So that's why it's banned in so many places.
I'm just thinking, I mean, we also widen the spreads during volatile periods.
Yeah.
But those are just so because we are taking on more risk. If it's a more volatile period, it's higher chance for us making a loss, and then sort of that's reflected in the spread.
Yeah.
But I think that's nothing to do with as my host mentioned.
Yeah. So like your CFD broker can see your positions, institutional market makers cannot. And the reason is because of the regulation involving CFDs, which is why they're banned in the US and a lot of other countries. But yeah, that's the main thing. I did have another question, which is about, this isn't from TikTok, but just what are you doing right now in your personal accounts? Are you investing in anything? Are you staying in cash?
Yeah, that's a good question. I am. It's sort of tricky, right? You think about inflation, you think about sort of holding on to cash because the market's gonna go down further.
Yeah.
Maybe. On the other hand, you have situations where you think maybe all the interest rates hikes have been priced in, and maybe the market's bottomed out and it's only going to go up.
Yeah.
And so it's always this tricky environment, which I guess all of us sort of go through, where we are like, do we hold on to cash and the market's bottomed out? Do you put in the money in the stocks that you think are value stocks and go for it, or do you still hold on to it? Personally, what I like to do is currently I have a lot of my money already put into the market.
Okay.
And
in risky assets like S&P?
No, I'm quite safe. I do. I mean, I guess it depends on how you look at it. For me, most of my money is in tech stocks, US tech stocks. primary the big ones, Amazon, Apple, and Microsoft.
Yep.
You can call them risky, maybe you can call them not that risky. I would probably say they're not that risky. They're growth stocks, and right now, for example, Amazon's doing really bad in terms of stuff. The price are really low. It's $89 per share, up from the peak of 186, I think, last year.
Yeah.
It was, I think, it's trading at a really, really good discounted price, and so I've
A lot of things
taken the
are
bulk
cheap, yeah.
and put in the money. Apple's down to 139, I think.
Yeah.
And even though last week it went high as up as I think 155,
Yeah.
but it's come down to 139, so I've put a lot of money in there. Microsoft gone down, but I think these are all companies that are gonna do well.
Yeah.
Apple holds on to is sitting on a lot of cash.
Yeah.
That it holds, and it has, you know, Apple as a product is very, very sticky. People who have sort of moved on to Macs or iPhones really like the product and want to continue with it. And you have the frenzy where every time Apple comes up with a new product, everyone wants to get their hands on the latest one.
Yeah.
So they have like these really sticky points, and people are very conscious about owning them. So I think they have a good market in place. They also are getting into services. So you have all of these services that are provided for the Apple products.
Yeah.
They also get into healthcare. They want to sort of pivot themselves into a health company. I don't know if people have heard of that or not.
I haven't heard of
But
it. So you're very bullish Apple.
Yeah, I'm
Sounds
very, very bullish Apple because a lot of my money is at stake over there. But also, I think as a company, it's doing a few things that are very, very that are really good.
Yeah.
For example, with Apple Watch, they want to sort of pivot into health. They want to make sure that Apple Watch can be used as sort of indicating to your family or people about your health if you've sort of fallen down the stairs or something like that.
That's pretty cool. Yeah.
And I think and they really want to sort of push down into it. There were also talks about Apple moving into cars, self-driving cars. I don't know when's that gonna happen. We've been hearing about that since the last 5 years or something. They've got into partnerships with Goldman and so on for offering financial services. So I think there are a lot of potential there. There's a lot of scope for growth, and even if the product businesses sort of seems to be sort of stalling, you have the service sides that they seem to be growing. Amazon, where do I even start? You have Amazon offering AWS services around the world. Everyone's sort of using that. They've revolutionized the field.
I don't know a single quant dev that hasn't used AWS.
Yeah, exactly. So all of us use it, not just in our field, but even in big banks, small banks, startups, everywhere you see, it's really, really good. If you think about buying something online, everyone thinks about Amazon, and they are investing a lot of money in technology, in R&D.
Yeah, they're surprisingly diversified.
They're diversifying into a lot of things, and I think they're doing a really good job. I think the price that it's available right now, it's really cheap. So I would be very, very bullish about it. I think, and the sort of the horizon I'm looking at is 5 years, 10 years. And I think in 5 to 10 years, I think these companies are going to do really well.
Yeah.
Even though the markets right now seem sideways and seem to not be sort of going anywhere.
Yeah. So I'm doing something very similar. Like I dollar cost average into a tech ETF and the S&P 500.
Right.
So the tech ETF is focused on all the names you just mentioned.
Yeah.
I think Apple and Microsoft are the highest names in there.
Yeah.
In weight, and then the S&P 500, obviously just the S&P 500.
Yeah.
And then I'm also currently rolling U.S. Treasuries.
Oh.
So short-term bills.
Right.
So that I do that through my Charles Schwab account, just because it's like 5-6% yield, and they expire every 3 months. And so like when I have my major cash positions, I've stopped dollar cost averaging.
Right.
Because I think I stopped maybe a month and a half ago, just because I'm like I think it's gonna go a lot lower.
You think it's gonna go a lot lower?
Yeah. Like I think the market is too bullish on what's going to happen. So they're pricing rate cuts for next year. And the Fed is saying, we're not going to do that. We're going to keep rates high for longer, for as long as it takes.
Right.
And obviously the Fed has changed the narrative quite often. And no one knows what's going to happen. It's all data dependent. But I think when we're dealing with 10% inflation rates, it takes an average of 6 months for rate hikes to translate it to the economy.
Yeah.
We're not even at peak terminal rate yet. Fed says it's going to be 5 or 6%.
Yeah.
Once we get there, we have to stay there for longer to see that long-term inflation come down.
Yeah.
And they're going to keep it longer to see the data feed through because they're not going to see the effects of their hikes come through yet.
Yeah.
So I think the market pricing of cuts by end of 23 is a bit bit too bullish for me.
Yeah.
Yeah.
I mean, I do agree with it. They're saying that they want to get the employment numbers are gonna go twice of what it is currently.
It has to.
In the UK, and it's gonna be it's gonna be very painful.
Yeah.
But I also feel, and you're right. You never know with Feds, to be honest. They sort of change their narrative.
Data dependent.
Yeah.
Quote unquote.
They change their narrative every so often.
Yeah.
So it's tough to say, but and I mean, personally, I feel given the sort of stocks that I'm investing in, or the monies that the stocks that I'm putting my money in, they're all stable stuff.
Yeah.
And even if they go down, I'm just going to keep buying, and hopefully it's going to go up.
I think that's definitely the right thing to do if you already own something. So I would do the same thing in my ETFs. The only issue is I'm worried they're going to go down, and I think a safer bet for me personally is to roll the treasuries on every 3 months. And because I don't own any single names either.
Right.
So, sorry. If you own a single name, I think it makes sense to add more to it. But if you own an index, you're just kind of diversified already. It doesn't make sense to buy a fraction of Apple, fraction of whatever. Yeah. So, if you're very bullish on these names, it makes a lot of sense to keep adding. So that's kind of what I'm doing. I also had some crypto algorithms running. I stopped them out recently, just because everything was going sideways, and until the macro environment clears up, I don't see the point in turning it back on. Because some of them are momentum-based algorithms, and one of them was a crypto exchange arbitrage one, which again works on the concept of spreads that we spoke about, and that doesn't work very well anymore. Because when everything is sideways, everything gets priced like everything is trading sideways. In a low volatility environment, everything's cheap. The spreads between exchanges are super small, so I can't make much fees. That's not doing anything. What's your personal opinion on crypto, by any chance? Do you trade any?
I don't trade any. I sort of stay away from it, and that's only because I don't understand it too well. And that's probably down to me not sort of trying to understand it. And also, I just sort of like to stay away from it right now. I'm again quite risk averse. So I just want to invest in the safer sort of investments,
things you understand,
I understand. Yeah. And there's a lot more information available about the companies that I invest in. So you can look at the sort of portfolio. You can look at the balance sheets. Understand what's going on with in the company. With cryptos, because I don't understand it, it's one of those where I don't want to play with fire because I'm afraid of getting burned.
Yeah, that's completely fair. Crypto is definitely one of those environments where the tech is hard to understand, the use case is hard to understand, and the retail momentum-driven hype around the entire industry is so high that it's very hard to distinguish what's fundamental and what's momentum. Yeah. Obviously you can trade both, and there's a lot of people that trade the fundamental side of things. There are genuine use cases for a lot of these things. I don't know if you've heard of Stellar. It's like a cryptocurrency. They're not that big, but they're insanely popular in financial services because they provide blockchain technology. They're basically like a software solutions company. They have a token associated with them, but most financial services companies use them because they're one of the only crypto companies that are really, really risk averse and really follow regulations for whatever company that wants to partner with them. So I don't know if you've heard about this rave about tokenization happening in financial services.
No, you haven't.
So there's a portion of asset management where clients get a unit in a fund. It could be a UCITS, an ETF or whatever. So when you buy an ETF, you get a unit. The process of transferring that into someone's name is done through a transfer agent in the industry. And a transfer agent takes a fee and that gets transferred onto the client. So your client paying that 3% or whatever fee you normally see, or 0.1%, whatever it normally is on ETFs or UCITS. That goes partially to these transfer agents and partially to the asset manager. Yeah. And if you tokenize the asset, you can cut out the transfer agent and you eliminate that source of fees for your client. So there's a huge trend in the industry now to tokenize existing funds, as well as tokenizing illiquid things like private equity investments, things like carbon credits. Yeah. And that's really popular actually right now, so tokenizing illiquid things. Because and this is mostly for primary market issuance. So if you want to buy a part of a private equity fund, it's completely primary markets. Not many people have access to it. They have a certain amount of money, you need to know the right kind of people. Yeah. But if you tokenize the entire fund, you can buy a fraction of it. Right. And that way you're able to raise money better. People can get access to these markets better. Right.
I've heard something similar happening in real assets. So a lot of people sort of want to get into farms,
Yeah, yeah.
and it's really funny because coming on my way over here, I was reading this article where they said that Bill Gates is investing a lot of its money in farmlands in US,
Okay.
and 1% of the entire farmland in US is owned by Bill Gates as of now,
I did
and
not
that's
know
a
this.
huge number if you think about it.
Yeah.
And so it also highlights how, if you sort of want to buy 10 acres of land, that's probably gonna be, $1 million or something like that.
Yeah.
And most people don't have that sort of money.
Yeah.
But if you tokenize it and reduce it down, you can buy parts of it, and so you can have a certain percentage of land, and that way you're also owning real assets because
Yeah.
with inflation going on, a lot of people want to get into real assets.
Yeah, yeah.
With everything going on with war and so on and so forth, everyone thinks what's gonna end,
Yeah.
and how do you hedge that? You this becomes really really good way of hedging your risk and your positions.
Yeah.
Getting
yeah.
to real assets and tokenizing it is a great way to make sure small retail investors can get into it.
Yeah, I can't remember who did this, but there was an article that came out like many years ago about, I think it was some sort of real estate company in Miami, I think,
I think
that tokenized real estate, so you could buy a portion of an apartment. I can't remember who did this, but that was a long time ago.
Yeah.
That was really cool. Yeah.
The other asset class that I can think of that this is happening, I think, is art.
Art. Yes, you're seeing it in NFTs already, right?
Yes, and so you have all of these companies and all of these paintings that are really expensive, and that's sort of the price is derived from what people want to pay for that.
Yeah.
But again, because these are so expensive, a normal retail customer cannot sort of get into it.
Yeah.
And if they want to hedge out their portfolio, diversify their portfolio, then it's really really good way of sort of tokenizing it and getting into it.
True.
And
so like my only pushback against tokenizing things that are semi-liquid is you can buy an index that tracks it, and that's probably going to be cheaper than tokenizing something. Because like if you think about it from like a company point of view, so like for certain things I agree. Like if you're paying a lot of fees for transfer agents for particular funds, that makes sense. If it's an illiquid market, that makes sense. But let's say you're tokenizing Apple shares. We already
That
have
doesn't make sense.
we already have fractional shares.
Yeah.
Or like if you're tokenizing artwork, we already have art indices. We already have like indices for things like whiskey and wine.
Right. To be honest, I didn't really know that the indexes.
I don't know how liquid they are, but I know they exist, and I don't know what the fees look like if you wanted to buy them.
Yeah.
But
To be honest, I guess one of the ideas behind tokenizing is that it becomes available to people.
Yeah.
Again, if you're indexing it becomes easier because you can then buy a part of it, and you don't have to buy an entire collection of art or one painting that's worth $1 million or something.
yeah.
But yeah, I like the novelty of it. I like how it's sort of socialist in that sense, breaking down barriers and making these asset classes available to people who wouldn't be able to afford it otherwise.
I think it's one of the best things that's happened to finance is tokenization, because it opens the floodgates for retail investors to invest in things that were otherwise inaccessible.
Yep.
That's why I want it to happen in private equity. I want it to happen in these other industries because they're insanely illiquid, and typically you need to be a high net worth individual to participate.
Yep.
Same thing with hedge funds and whatever. The reason I like it is because we've seen from Robinhood that these guys have an influence on the markets. Whether it's positive or negative, it doesn't matter.
Yeah.
But I like the fact that people have a voice now. They can express their opinions. They can come up with their investment theses on Reddit or whatever it is.
Yeah.
And they can go be degenerates if they want to.
Yeah. No, I completely agree with that. And I actually love the idea as well. The fact that you're making the market more accessible to people.
Yeah.
And if it works, it does not work, whatever happens, whatever the philosophies are, it's up to them, but at least it's making them available where they can do what they want to do. So I think I really like the idea as well. Yes.
Yeah, definitely. All right, let's jump into some questions before we get some comments and be like, why didn't you answer any of the questions?
Right, okay.
All right, let's see here.
Solve some third degree equations.
No one's going to ask you to do integration anymore.
I won't be able to do it.
Okay, so someone is asking, his name is Gonorrhea. Any tips on how to be a quant without a master's or a PhD? This person is a final year math student for reference.
No, that's an interesting question. And firstly, it's extremely possible now. I don't think degrees of hold. Again, it's sort of breaking down those barriers. Degrees are no longer the gatekeepers that prevented you from getting to these industries or fields just because you did not graduate from Harvard or MIT with a degree in pure quantitative field.
Yeah.
I think what most of these people, at least bank that I'm working with, what people are looking for are people who are curious, who are smart, who are willing to sort of question the status quo.
Yeah.
You obviously need to know a certain amount of tech on your side. You need to know, need to understand the market and so on. But it's not very tough. If I remember correctly, you said he's a final year math student, so
Yeah.
you already do understand the math behind a lot of stuff. You understand the quantitative field. All you need to do is sort of brush up on your basic tech stuff.
Yeah.
And you should be able to get in. But and we've had people who studied philosophy who have sort of interned in our banks.
Yeah.
And it's not tough because what happens is,
But is that in quant or is that in general?
in general.
Okay,
But
okay.
but for example, the thing is, these things are easy to teach. For example, the asset class that I work in,
Yeah.
FX market is not tough to understand. If you understand bid, ask, your game.
Yeah.
What you need to understand is you need to have the curiosity to learn, curiosity to question stuff.
Yeah.
If you're able to think critically, break down complex ideas into simpler structures and simpler forms, and understand, I think that's what counts, and that's what should be the ways of go about it.
Yeah. Yeah. I think if people have the skill set, they're definitely capable of showing that, and that would definitely shine through.
Yeah.
I do know a lot of graduate schemes nowadays, they do have a minimum master's, and I've seen a lot of pools for jobs that are typically entry-level quant positions that are normally minimum masters.
Right.
Half the pools now that apply are typically PhDs.
I guess, okay, this is my unpopular opinion over here.
Yeah.
I think what's happened in UK and Europe
Yeah.
is that it's quite cheap to get a PhD or a master's because you have the government sponsoring it,
Yeah.
or you have the state sponsoring it,
Okay.
or even if you're working as a PhD student, you have certain amount of money that you're making through the government fund and grants and so on.
Yeah.
And so what happens is a lot of people try to get into these degrees and try to do a master's. And what happens is that skews the market. So now that you have 100 people doing PhDs or masters because it's easily accessible to do it in certain countries,
Yeah.
the number of jobs that are available, people with these higher degrees are going to apply.
Yeah.
And so automatically the barriers of shifts
Pool.
up.
Yeah. Yeah.
What happened in US is because it's so expensive to do it and it's so time consuming, you have to pay it from your own pocket. A lot of people don't end up going for masters or PhDs. And
Right.
so if you see similar roles advertised in US, would probably have people from undergrad degrees doing it.
Yeah.
And similar role in UK and Europe, you'd probably have people with masters or PhDs of going for it and applying for it.
Yeah. I
And,
definitely
and
agree.
it's really tough. I mean, if you look at 100 applications as a recruiter you get on your table,
Yeah.
90 of them have PhDs, and you have to sort of filter them out. You're obviously going to be like, what if 90 PhDs are applying? Let's just remove these 10 people who just have undergrad degrees.
Yeah. Yeah. And I think the industry is aware of that. So like in the UK, you have apprenticeships,
Right.
and you have graduate schemes where you can apply for quant stuff as well.
Yeah.
So I know NatWest does a graduate scheme. I know a lot of different companies in the UK do graduate schemes where the
Yeah.
minimum is just a bachelor's.
Yeah.
And I think they're aware of this, but I think I agree it's to do with the saturation and the accessibility. But I also think a lot of the problem is with the universities and the quality of the education. Like we saw this in our masters as well. Like the quality of education is extremely poor nowadays, I think.
I completely agree.
Even at high level universities.
Yeah,
Like we went to, I'm
yeah.
not going to say the name, but we went to a pretty high level university for masters.
It's in probably the top 10 in the world if you look at the global ratings or rankings of the university. So
it was
really,
awful.
Well, yeah.
It was awful.
And there's no two ways to sort of say it. It was awful. It was really, really bad. We can sort of blame that, maybe because of COVID and remote learning, maybe it was bad, but it
was already a year into COVID, right? So
and the quality of education offered by the professors was probably not up to the bar. But not just that. This is a master's level degree that I'm talking about. Even if you look at undergraduate degrees in UK, I'm just surprised the number of holidays that you get, It's something that I was not aware of. A 3-year degree over here, you're probably in a year spending 4 months as part of vacation or holidays, or, you have Easter, you have this and that. So your 4-year degrees, so 3-year degree sort of ends up becoming a 2-year degree because 4 years sort of gets this cut out as
yeah, I mean, I think part of it...
these are, again, unpopular opinion, People don't have to agree with me, and they have to be like, oh, you don't want us to take vacations now and don't want us to celebrate Christmas. You completely do that, celebrate Christmas and celebrate all of the festivals that you want to celebrate. But at the same time, if you're offering a 3-year degree, and if you're spending one entire year as part of vacation, and it just ends up becoming a 2-year degree, then you really need to look at the degree and see if you're getting the value that you're after.
Yeah, I think students are the victims here.
Yeah.
Like, even though you get more vacation time and more time between, so like the way I had it in the UK for my undergrad was like you had a lot of months before your exams, whether it was your first term or your second term, but you had maybe 2.5 to 3 months before you had to do the exams, which is typically study leave.
Yeah.
No one studies.
Yeah.
And you don't need those 3-4 months to do this stuff, but they were there, which meant that you're paying like insane amounts of money for what should be like a 3-4 year degree, and it's not. And I think the quality of education is probably my biggest gripe. Like, I don't know if it's just a UK thing. I think it's a global thing because of the number of students that are getting pushed into education. It just makes sense that you water down the level of education so you can teach it quicker, pump out more students, and earn more money. I think education as a business is kind of formed into that.
I guess yeah. The 2 points that I have, I'm sort of struggling because there's so many things that I want to say. I completely agree. Yes, the number of people who are getting into university education is way higher, but that does not sort of mean that you sort of water it down. I think you have different levels of education. You have different universities where you have people who are sort of scored higher in their school, can go into a better, but better ranked university where the education stuff or the quality of students are coming in are sort of slightly higher.
But they're taking in more of them, right? So like surely if you think about the attention per student that a professor might have for the quality of education to teach those students, like I know on our course we took in people that shouldn't have been on the course.
Yeah.
100%. And they were brought in on like bare margins and they struggled throughout the whole thing. They still passed it with probably flying colors because it was during COVID.
Yeah.
And it really watered down the course, I think.
Yeah, and I completely agree with it. And just to sort of put it in perspective for some of our listeners over here, the way it worked is we had people from different backgrounds coming in. So people who had studied pure quant stuff, maths and physics and computer science. But on the other hand, you have people that studied economics or sort of a less quantitative degree. And so when you bring all these people together, you sort of need to bring them at the same level, which meant that people from less, quantitative degrees had to learn those calculus, and which meant the entire education level sort of went down as like my host put it.
Yeah, because like as a professor, you kind of need to do that in a way to bring up, like you can't just teach people if half of them don't understand what you're saying.
Right.
So you need to like do these. That's why there were so many like these like seminars, right, and like teaching sessions, just because to help those people. No one attended. They knew no one was going to attend because of the time differences because of COVID.
But this is what my suggestion is. Why don't you make sure that people, even if you get these people into the course because you want that money and you want the international dollars to flow into your bank. Why don't you make sure that these people learn those skills before they come in? Tell them that these are the preparatory courses. If you can't do it, I'm sorry, you're gonna have to fail.
That's what I thought we were already doing. Like I know for our course, like I thought that the minimum was like insanely quantitative. Yeah. Like it didn't even specify what it was. It just said it had to be quantitative, and then you would apply. They would verify whether or not it was quantitative, and then you get enrolled, right? If you had the good enough grades or something. And it was just so surprising to me. And it wasn't just our course. Like I had people at, again, maybe top 5 universities in the world that had the same problem. And it was like, I think the quality of education since COVID has only gone down, is like my controversial opinion. I think it was already on a steady decline, but I think COVID was kind of like the catalyst that made it even worse.
No, I do agree. Yeah, I can definitely see COVID sort of exacerbating that sort of issue and making it worse. I'm just thinking, from a university point of view, they're doing it because they don't really have enough money and they probably need the international dollars to sort of flow into their account.
Yeah.
And it sort of then goes back to the fact that maybe the universities require this money either because the salaries that are being paid out to the boards are really, really high and they're paying some really insane amount of money places where they shouldn't be paying.
Yeah.
And there should be an overhaul of the business model of universities. Yeah. Or either universities need to be sort of taken back by the government. I don't know, how does it work? Are these private universities? Do they have burglaries? Are they funded by the government? Are they funded by just the tuition fee of the students?
They're partially funded by the government here. I think I like the Scandinavian model is to make them all free, because that way it forces universities to kind of compete with one another for quality. Because like if no one has to pay for it, they get fully funded by the government. I think the only logical way you can compete is through quality of education.
Right.
But if you're paying for it, then you have an incentive to get more students in,
Right.
and an incentive to water down the education to pump out more students year on year. In order to, like, if the course is easier, more people are going to apply, more people are going to pass, you look better in stats, people apply, you get more money. So, like, I think this is kind of business cycle kind of aspect to it that kind of ruins it.
If this phenomena we are observing in Europe and UK, do you think it's not happening in US?
I think it is. I think it is in the US as well. Like, I've heard the same thing. So I don't know about other degrees, but for Quant in specific, they're all being taught by business schools now, and no one is hiring those people for masters specifically. Like, I spoke to a couple of guys about this because, like, my company is mostly based in the US, and I got sent maybe 100 CVs for quants. And we literally had a discussion about this in the global quant team. So, like, I work at fixed income, but we spoke to people from the global quant team in equities and FX and all these other asset classes, and we all have the same opinion, which is like, anyone from a quant business school, a quant degree from a business school, ooh. And the main argument for that is, like, they don't get taught any maths, they don't get taught any stats. We don't care how much you know about finance. We don't care how much you know about accounting. None of that stuff matters. What matters is the fundamental mathematics and stats. Because you can, like you mentioned before with your FX thing, you can easily teach finance. Like 90% of it is just jargon.
Yep.
Like
100%. Yeah.
So, like, it's a lot easier to teach jargon than it is to teach fundamental mathematics. Like, how do you teach someone integration by substitution for the first time, or sorry, integration by completing
you
the square?
You can't do that once you've started work. You can't ask someone to sort of sit down and explain integration to them. You can sit down and explain how bits work and spreads work, and what's butterfly options or something like that. But it's really tough to explain. So I completely agree. And so. You're right. I guess the way to go about it is Scandinavian model, where you make it free, and so you make the universities.
I think that's.
You really need to question where the universities are coming from, honestly, and they can sort of put it very easily that maybe they're competing for the international dollars in the market and want to get these international Chinese and Indian students and from around the world.
From a foreign perspective, and I'm sure you agree, it's prestigious to go to a foreign university wherever it is, and if you attract those kind of students and become well known for that prestige, you just earn more money from foreign people. You hedge out your bets in your local country as well. Makes sense. All right, I think we should change the topic. We've been speaking about universities for I don't know how long this is. Like, I don't know, 20 minutes. We got a question from Nick. What languages are quant devs mostly using? Python, C++?
Right. Again, this is such a broad soft topic. It again depends on asset classes. The asset class that we deal with, FX Spot, is very, 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 very liquid, which means it's high frequency, low latency. So you need to use something like C++, which requires you to program really fast. You can process stuff fast because what's happening is we are looking at markets at so many different, levels, and pricing all of that has to be done really quickly. But we have we have FX forwards that's built in Java. We have some of our other stuff that's built in C#. So it is agnostic to a language. It depends on what functionality it is trying to meet. If it's looking for something that's garbage collecting and something that needs to run at long periods of time, Java is the way to go. If you're looking at something that's low latency, C++. If you're looking for something that needs to be churned faster, and you don't really care about latency. You're talking about structured products or something like that. Python sort of does the trick because it's really quick to get in, create strategies, test stuff and so on. So you have all sorts of languages. What again comes down to the core, or what sort of comes down to it is the skill set that you bring. Languages can be taught. As long as you understand the fundamentals of technology, understand the fundamentals of how do you program, how do you sort of go about it, how do you make stuff, that can be deployed in a production environment, I think you're good.
Yeah, I definitely agree. Like, I think it kind of goes back to the whole education thing. Like, if you know your fundamentals well, you know your maths well, you know your stats well, it doesn't matter what programming your language you're programming in, because you should be able to implement those models and those procedures in any language. Because the math is the same. Yeah. So you're just learning notation from a programming point of view.
Exactly. And those things are not tough. Honestly, I mean, you can pick these things up. If you're smart enough to pick up the complex math stuff, you're more than capable enough to pick up those things.
I do hate C++ though. With a burning passion.
And why is that? Why is that? Why do you hate C++?
It's not intuitive for me to program in it. Like, the way I think in terms of like processing and programming I can translate that into Python more easily than something like C++. There's more things you need to worry about in C++ than there are in Python.
Absolutely. And I completely agree with you. It's not an easy language to program in. It's the too many, what are those called? Pitfalls that you can fall into and so hurt yourself and hurt the program.
At least you don't have
Python
to
is more intuitive. It's easy to program, and that's the reason why it's become more accessible to a lot of people. People from background that do not study engineering are able to get into this field because Python's made it accessible. And that's really good.
Yeah, definitely. Like, so I kind of work in between quant dev and quant researcher as well, and it's very similar. Like, we use mostly Python, but we still need to know how to do other things. Like the amount of production code that needs to be low latency. Obviously, you're gonna have something that needs to be like that, and there's no way you're programming that in Python. The amount of how slow it is just insane. And so being able to control every aspect of that process, like, because you have to define it in C++, it makes it a lot easier to get that control of your latency. And so sometimes you do have to do that. But I also think, like, if you're from a quant dev background, you also need to know core technologies as well. Maybe for Python specific, but things like Docker, Kubernetes, orchestration of different systems, that's pretty important too. I don't know if you do that in your place.
So again, stuff comes down to the size of the team. I would say you have some teams that are so vast that you have a separate DevOps team. Where they're gonna handle all of this. All you need to do is work on the core algorithm stuff, work on the core pricing and hedging models, and rest of it is taken care of. Some of the teams that on the other hand, you have some of the smaller teams where you have to handle end to end, where you're deploying stuff, and so you need to understand DevOps, you need to understand Kubernetes and Docker, and you need to understand how to deploy stuff, Ansible, and so on and so forth. So I think stuff comes down to size of the team and what sort of responsibilities are there. But again, these are tough if you think about it, and you'd be like, oh, I don't understand bash scripting, because that's fundamental, that's something that we use, but that's something I didn't know. But these things are things that can be learned on the job. They are not tough. And so these things shouldn't deter you from applying to these positions, because you're like, I don't meet the criteria, I don't understand bash scripting, I don't know Python. It's okay, you don't understand these. Let's see, what do you understand, how can you think, and so on and so forth. I think these things are easily accessible. You shouldn't stop yourself from applying to positions just because you don't.
Definitely not.
And go out there, apply, try your best, and if things work out, they work out. Get the job that you're after.
I think that's
good advice. Don't stop yourself just because you think that you shouldn't be the reason that you don't get a job. You know what I mean? Like, you shouldn't stop yourself from even applying, because there's nothing wrong with applying. You think it's too out of your reach? Go for it. Apply for the CEO position of a company. What's there to lose? You go to the interview, you embarrass yourself, they ask questions that you don't have answers to, you go home, cry, eat a burger, sleep,
Eat a burger,
do you understand my point? Like,
like, the job descriptions they're very targeted.
And exactly. And they try to sound, these HRs don't even understand most of the stuff when they're putting out these job postings.
No one does.
Just honestly apply to the job. If you think you meet 50% of the criteria, apply. What's the worst that's going to happen? You're not going to hear back from them, or you hear back, you go to the interview, they ask questions you can't answer, you just learn something new. You
learn something new, you know how something works, you move on. Like, that's what the job application process is about. You fail 90% of the time, and then maybe
you should be open to failure. You should be open to rejection. There's nothing wrong with it. Everyone goes through it, and it's just a learning curve.
Definitely, 100% agree. Like, I wouldn't consider myself a software engineer or anything near to it, but when I was brought into the role, that was the expectation. Good. So, like, I'm working with existing systems in Python. I'm like, okay, sure, let's figure this out. So you sit down, you put pen to paper, you figure out what you need to learn, when you need to learn it by, and you just fill in the gaps. Like, I think that's the one good thing about university, especially at a higher level like master's or a PhD, is that you learn how to figure things out by yourself.
Absolutely. I think, and that stuff comes down to it. It's all about critical thinking. And so it does not matter if you studied engineering or you studied, philosophy or anthropology, because these things, if it's a good course, they would teach you the right skills. It will teach you to think critically, question stuff, break down complex things, read a lot of information, break it down, and so on. And those are important skills that people should be after. Yeah,
definitely. So I do have some more questions. This one is servant of God. Is it possible for retail to model regime change? And how would you go about it if you were a retail trader?
What does that even mean, model regime?
So regime changes, like if let's say you're modeling volatility regimes.
Oh, model regime, right? Okay.
So, like from my perspective, I would do that with like a hidden Markov model, maybe a Bayesian model. Although I hate Bayesian statistics with a burning passion.
Right.
But you can answer if you have any opinions on that.
Honestly, I don't. I don't even understand the question too well, to be honest.
So like regime changes, if you're looking at a time series and
Right.
or like a signal or whatever it might be, and you want to see if the signal is inherently different from its past, how would you model those structural breaks?
Oh, right. Okay. I'm gonna come back to you on that.
That's fine. So yeah.
I mean, it comes down to what you were saying, right? You said how some of these cryptocurrency algorithms that you're deployed, they don't work as well right now because the market's sort of sideways.
Yeah.
But what do? If your old strategies don't work, you see what's happening currently and then deploy new ones.
Yeah.
So you should be always open to understanding that, you know what, this one's not working, let's move on to the next one.
That's my whole job.
Yeah.
That's what quants do. We build things, they break, we build new things.
Yeah, and it's all about feedback. I think what's happened is, again, it's all about the failure, and we are afraid of failure.
Yeah.
We are afraid of things not working out. And something that you can learn really well from Silicon Valley is the philosophy of moving fast and breaking things.
Yeah.
Deploy stuff, it breaks, understand it, feedback it. Version 2, which is slightly better. It breaks again, do something else, and keep working at it,
It's a good show, to be fair.
And honestly, that's how it works. You are not going to hit the jackpot at the first try, especially if you're starting out for the first time in the field.
Yeah.
You start in momentum trade and realize that it's all, mean reversion, and next day you deploy mean reversion and you realize that this doesn't work. And it's fine. Try to figure out what works and do it. You make some loss, and that's the reason you don't go all in. You don't sell your house and, over leverage your position. Go small positions, understand how is it working. If you think you're making money, put in more money, and so on. But always put money that you're willing to lose.
And this is for retail, by the way. Like in the
and even like, unless you have a proven formula that works 100% of the time, which you will never have,
this doesn't exist.
Don't go all in. Understand what are the risks if you're willing to lose that money, and be smart about it.
Yeah, and that's completely fair. Yeah,
and be open to changing stuff. Things break, things don't work out.
Yeah.
The market's so volatile right now. We are unprecedented time. We are at a time where we are talking about recession and inflation at the same time.
Yeah.
We're talking about, some people are saying we are already in recession. Bank of England, for example.
But unemployment is close to
exactly. Unemployment's not changed at all over here. People have raised interest rates from 0 point something to 3% now, and employment's not employment's not gone anywhere.
Yeah.
So we sometimes just don't know, and honestly, people who sit at these positions just don't know what's going on themselves. What you need to do is look at the information in front of you and take the call that you can take. Sometimes it works, sometimes it doesn't.
Yeah, fair. So from Madam President, and this was a pretty liked question, what are your thoughts on quantum computing, if you have any? I don't understand it well enough to answer that.
I don't understand it well enough too. I know someone from my team left recently to pursue a PhD in quantum computing at Imperial.
Yeah.
I don't understand it too well. What I do know is that there are possibilities and there are a lot of use cases for it, I guess, in future. But right now the technology is in nascent stage. We are not ready to sort of use it. But we definitely do need people to be working on these things, because that's what the future holds.
Yeah.
We are hitting limits in terms of hardware limits, in terms of what a single silicon chip can do, the number of processing it can do.
Yeah.
And so you need to move on to newer technologies that sort of breaks the barrier and gets into new things.
Yeah, that makes sense. I thought they almost found us here for a second, they found out my insider trading that was good, and then they're here to pick me up.
Yeah. All right. See you guys.
and you're right here. So I got quite a few questions about modeling, so I'm just gonna bunch them up.
Right.
What sort of models do you use in your job, if you're able to?
So most of our models are machine learning driven.
Yeah.
So we are using RNN models.
Okay.
If you're talking about these bulge banks, they're not as flexible as startups. So when we do a really long backtest process of 3 months, deploy stuff, by the time it's gone in, maybe the conditions have changed, but these models have stayed in for a very long time. So even though these RN models that we are using, they're not state of the art, they're not using the latest developments and the research that's going on.
And you build this in C++.
This is all C++.
Okay.
Yeah, so we are using machine learning stuff, but none of it is path breaking. All you need to know is basic machine learning stuff. You need to understand basic neural networks, and you should be.
Yeah. So RNNs are recursive neural networks.
Oh, right.
In case
Yeah.
you're interested.
Sorry.
So, like LSTMs are a part of that family as well.
Yeah.
In case you're interested. But yeah. So you use that to basically gauge whether or not the price is fair at that point in time, so you can get an idea of what the spread is
Exactly. So what we do is we calculate mids.
Yeah.
So we are taking in all of these different market data sources. We are looking at a lot of different stuff.
Yeah.
And determining what's the correct mid for the next tick.
Yeah.
And we sort of split that out. And then there are sort of different stuff that are added to it. Again, depending on the client, maybe we'll give wider spreads, thinner spreads, and so on and so forth.
If they're a bad client, they get worse.
Yeah, absolutely. So what happens is we see if they trade with us and they immediately go to the market and we make loss or something like that. And we are also doing these P&L calculations, which are not absolutely accurate and they're not exact science.
Yeah.
But there's some sort of logic to it. Yeah. And so we can sort of gauge if this client is working well for us or not as a bank. And if we think that they're not doing too well, then we put them on wider spreads.
Yeah.
And so we have these different streams and we put them on wider streams because they are not working well for us and we are making loss.
Yeah.
And then also depends on what relationship we have with these clients. Their new client, their old client, how much they've traded with us, what's the liquidity that they offer to us, how much money we're able to make, and so on.
Yeah. That's pretty interesting. I didn't know you guys used neural networks. I thought it was more like traditional pricing in terms of like stuff you were taught back at university.
We actually use none of that.
Yeah.
Surprisingly, we hardly use anything that was taught in the degree to us. But yeah, there we are.
Yeah. I did use it once, and it was again, someone already built the code, but it was so long ago that no one understood it and that person left, so I had to understand it again.
Right.
But someone built code on callable bonds,
Right.
which are pricing callable bonds with options, I should mention. So it's basically puttable or callable bonds. So you have both types, and we were producing a fair value model for those. And so basically the person that wrote it left, model broke, no one understood it. I was the only person that did like one term of financial engineering. So like, go figure it out. What's happening here? I'm like, okay. And it was written in MATLAB, which was kind of insulting.
Right. So yeah, that's
the one thing I like about MATLAB is it's really easy to go back and understand what's happening. If someone wrote that in Python, I would shoot myself on the spot. Just because, like, how do you... Like, Python doesn't have an inherent library for financial engineering. It has a couple bits and pieces, but they're all programmed into certain assumptions that are not common.
Yep.
And when you're pricing things in the industry, no one uses a textbook equation to price things, right?
Yeah.
And so it was very different, and it took a while to do. That was the only time I've ever had something from uni show up. Ever.
Yeah. I mean, I guess it's just coincidentally both of us have ended up in jobs or asset classes that do not require it. But I'm sure there's some people out there from our degree using what we studied.
Yeah, definitely. Yeah, I think that my undergraduate is probably the most important so far because I did like financial economics and stats, and so the stats is insanely useful for quant. The financial economics is really important, but also the core economics part is really important for fixed income as well.
Right.
You understand supply and demand, how things work, how interest rates affect markets, all this kind of stuff. So that's been really useful. Let's see here.
Do you regret doing this master's?
No. I don't regret it because it was... Although I didn't get the content I wanted, I learned a lot by going out of my way and digging deeper into topics that I was interested in. And that led to a lot of opportunities. And also just all the people I met along the way. Like, do you have any books or resources you would recommend for quant finance?
Oh, wow.
There's only two I always talk about, which is Campbell Harvey and Marco Lopez.
Yeah.
But if you have any yourself, you can...
I can't really, to be honest, think of any. Yeah.
There's not a lot of good ones.
And I guess, I mean... It's so hard to sort of say this, right? Because there's so much content out there and it varies so much across different stuff. How do you, like, what do you mean? Do you want to study to get into a degree? Do you want to study for an interview? Do you want to study for your job? And so, the job books that are recommended sort of varies across that.
Yeah. Like I think the crucial thing is it's not going to be one book that teaches you
Yeah.
everything you need to know
Yeah,
about quant
yeah,
finance
yeah.
or how to get a job in quant finance. It's going to take, it's more than that.
Yeah, and I think the way this works is, and it's something that I made a mistake in. What happens is you search online, you're like, oh, quant finance book, best quant finance book. You
Yeah.
read one book and you're like, okay, fine, I'm gonna read this book and I'm gonna be an expert tomorrow once I'm done with this book.
Yeah.
It doesn't work that way. It's a continuous process. You start with a book. Some books work for some people because the language is understandable. Maybe the examples work for some people. Some
Yeah.
people like books that are short and crisp. Some people like which are more elaborate and expand stuff on some of these things.
Yeah.
So I think it all varies a lot, and the way you should go about it is try to see what's available, try different stuff, see, okay, maybe I like this book, I don't like this book.
Yeah.
Is this working for me? And move on to the next one. There's so many books available now in the
Yeah.
market. You don't even have to go for books. Go to YouTube and search, and you'll find the resource that you're after.
I think that's a better way of going about it.
You have online courses available, so you have lots and lots of stuff available. Just don't restrict yourself to a book and be like, you know what, I'll study
This
this
is
book
everything, yeah.
and I'll understand fixed income, I'll understand this, and I understand
Yeah.
FX, and I understand all of it. It doesn't work that way.
Yeah, well, I mean, so for fixed income, I do have a book back there. Well, fixed income securities.
Securities,
I
yeah,
don't
you
know
can
who it's
see
by, but it's back there. This is something called.
The Bond book, which is also really good. I got a pile there, but I think it goes back to fundamentals. I think you do need to understand fundamentals well enough to read specific high level topic books.
Yeah.
Like
fair enough,
when I was working at the crypto hedge fund, I was reviewing certain books for a model because I was trying to implement a very complicated LSTM forecasting model, and I decided to take it straight down to the basics. I'm like, okay, I know how they work. I know what they're doing. I know how to build them from scratch, but I want to go out and read some books and look at some examples of how other people are applying it in the same field, and then I'll build it up from there.
Yeah.
So I found a textbook from a guy who was, I can't remember his name. I think it's Steven or something, but he wrote a book called Machine Learning for Finance.
Oh, I think I've heard of this. And
Steven
yeah.
something.
Yeah.
And when I went to the LSTM chapter, it had a mistake in it.
Right.
And it was such an obvious mistake to anyone that's ever dealt with model development that
Right.
it pissed me off to the point where I literally emailed the guy. I had him on LinkedIn.
Right.
So I sent him like a LinkedIn email. I don't know what it's called.
Right. In mail.
Yeah, in mail,
Right.
one of those ones. I sent him one of those to let him know.
Yeah.
He blocked me. He blocked me, and then I reached out to some other quants in the industry, like I'm not going to mention names, but there's some
Damn,
other
he's a
quants,
dick.
and they all said the same thing. Every time they mentioned this issue, he blocked them, and it turned out the reason was because he doesn't actually have an ML background. He was just one of those angel investors in a startup that involved tech, and he wrote a book
Right.
and outsourced the book to someone else. Actually wrote it. He had a
Oh wow,
ghostwriter.
so like got a ghostwriter to write something for him?
Yeah.
Right, okay.
And it was an insanely popular book in quant
I
finance.
think I've heard of it, and if you search for, because what happens is these are all buzzwords like machine learning for finance.
It's such a buzz.
And
it's
that
such
book
a
will
buzz.
come up because it's right up there,
Okay.
and people will end up buying or getting a pirated copy somewhere.
Yeah. So the issue he made with the LSTM model, and I still can't believe he did this. He normalizes data before he split it. So he did like a 0 to 1 scaling,
Oh.
max scaling on his data before he split it, which meant that he was using like max values in the future to scale his data that he was training his model on.
Yeah.
And then when he showed his results, like the elbow plot was
And
like
it's-
99% accuracy, and I'm like, what? What? 99% accuracy in classifying time series in the future? Are you kidding me? That's impossible.
But that seems really obvious because you're reducing it out, and yeah.
Yeah, like, so in case anybody doesn't know, when you're training a machine learning model or a time series model, sometimes you need to scale your data so really extreme data points are the same scale as really low ones, your model can learn better. And when you're training your model, you typically split it up into two sets, a training and a test set.
And you can further split it into like training and validation.
And validation, all this stuff.
Yeah.
And the thing you need to be aware of is when you split it, your test set or your validation set has to have no association with your training set.
Yep.
So that, like, if you think about it, if you're training someone how to do something, you can't give them the answer when you're training them. It's the same thing with machine learning. You can't give your model the answer when you're training it. And this textbook basically did this rookie mistake of basically scaling the data before he split it. He gave his model the answer before he trained it, and that it was a big mistake.
So the idea is that you use the test data set that you sort of kept separately to determine the performance of the models. You train it on the training data, maybe you validate it on the validated data, and the way it performs on the test data sort of determines how good the model is. But you've already provided that data, and you've used that data to sort of train the model. When it's going to look at the test data, it's no longer looking at new data.
It's not
and so it's going to
yeah.
be able to predict really well, and so then the model figures are going to be completely off, as Post mentioned, 99%
Yeah.
accuracy or something insane like that.
Yeah. Which is it was really surprising to me when I came across
Yeah.
it, and I remember sitting like in my office
But
in a hedge
to
fund.
be honest, you don't even have to understand it that well to sort of look at it and be like 99%. Something definitely
Something's
seems
wrong.
off.
Yeah,
you know?
you can't. So for anyone that's getting like I don't know 80% win rates on TikTok in your
Yeah.
trading strategy, something's wrong.
Yeah.
like in the industry, it's
And
never that high.
exactly. In the industry, I just want to sort of get it back to us, where we are one of the biggest banks in the world.
Yeah.
And for us, our model performs at best maybe 50-55% of the times accurately, which means 45% of the times we are taking a wrong mid and we're gonna end up making a loss.
Yeah.
So the models are that bad, and this is a lot of people working on it over years and improving it. But because the data is such, and it just doesn't work.
So what metrics are you looking at to measure those performances? Because I think retail traders have a different definition of what a quote unquote win rate is. I'm not going to get into. Maybe we can get into that here. But
I guess
how do you define that?
So again, we have different metrics, but one of the metrics that I was sort of thinking about when I mentioned this was looking at how the model performed and how much money we made or lost on a single trade, looked independently from all the other rest of the trades.
Yeah.
And so looking at that and determining what's the model performance and all,
Yeah.
saw that this model is not that good, but it's good enough to make money, and that's how it's been. We've been sort of trying to increase it systematically, but it's a slow process. And any model, given the way it performs, because we did not price in Ukraine war crisis in our model. We did not price in an inflation coming in at this point, or a recession coming in.
Yeah.
So these things happen, and sometimes people look at how the market and be like, you know what, we're gonna go long USD, even though the US market's not doing too well, because it's just a safe haven.
Yeah.
And so people are gonna buy it, and that's something that our model does not predict. And so you can't really do much on these things.
Yeah, definitely. I think that's a good point, because like a lot of the LDI funds and pension funds in the UK had the same problem. Like I don't know if you knew about this, but they post gilts as collateral, and then lend it out to get like a leveraged loan in order to go out and buy equities, or buy some sort of leveraged product. But it's usually equities for a lot of defined contribution funds here in the UK. And the issue happened was the volatility in the gilt market shot up.
Yeah.
All of a sudden, their collateral was wiped out. They had to post more.
And was not worth it.
So they go out to the market, they sell their gilts because that's the most liquid part they have in the portfolio. Drives the price down further. Now they're getting margin called again.
Exactly, and
so
everyone goes out and
it's a death loop.
selling gilts, and again comes down to basic economics, demand supply.
And that was the quant's fault.
Yeah.
Like if you think about it, it's like the most basic thing you get learned in school is like the past is not definable, right? Like you can't carry the past forward to the future. Just because interest rate volatility hasn't happened in the past, it doesn't mean
it's gonna
And I think that's part of the stress testing process that a lot of quants need to do. But it's like I think people are too lax about it, because like when they build their model, they're getting like 30% win rates, or 30% accuracy, or R squared, whatever metrics they're looking at, F1s or whatever. But look at these metrics, like, oh, that's pretty low. Why don't we shock it by like, let's say 2 times the historical average of volatility? And you're like, historical average is insanely low. It's only been low because of 2008. Before that, it wasn't really that volatile. Why are we only doing it by this much? Why not do it like a crazy amount? And then people are like, oh, well, it's never going to be like that. And then it happens.
Exactly. And that's the thing. I remember reading, I don't know what was I reading or watching, maybe something recently. And they were like, some of these things that happened in 2008 crisis, they were like, they just seem statistically unimaginable,
Based on the past.
Yeah, based on the past. And they're like, this outliers by 33% standard deviation, 33% standard deviation or something. It's like, that does not make sense at all. But these things happen. And it's just that people don't factor these things in, because they always think it's not going to happen, and most of the time it's going to be fine. The way this works is we need to think about the black swan scenarios.
Which is kind of tricky, right?
Which is tricky.
No one knows what they are.
Yeah.
All you can do is go by history and be like, well, let's make it 20 times worse than that and see what happens. But I think one thing I wanted to touch on before we end the call or the podcast is that a lot of retail traders who trade in the FX markets and they're making money, they often define their win rates the wrong way. And I think that typically has a misconception to a lot of people who don't know how it works in the industry to go off and buy their courses or whatever they're selling. And the way they define their win rates is usually the amount of times you make money versus the amount of times you traded or lost money or something like that. And the way from a quant perspective, I think that's wrong, because the way you should define it is based on a model signal. How often did you make money the next day? How often did you trade? That's a win rate. You need to think about it in terms of false positives and false negatives.
Fair enough.
Not in terms of total trades and total wins.
Fair enough.
Trades.
Yep.
Because then you can pinpoint where where your profit and losses are coming from. Like, anyone can say that I'm making a 60% win rate, 80% win rate, whatever it is, based off of an obscure trading mechanism and whatever it might be. But you need to pinpoint where those sources are coming from. And that's where the quant aspect is really useful in terms of false positives and false negatives. So I think that's why a lot of retail traders are often of the opinion that you can have like a 10% win rate, and it is fine as long as your wins are bigger than your losses. That makes sense logically, until you start digging into the details and you're like, a coin toss can have a 50% win rate and you can make more money than you lose. Does that make that a good strategy?
Yeah.
And then you start getting into the aspects of like, well, how do you measure random and what's not?
Yeah. No, it is a complicated science. Honestly, it's not that easy. Even it's something that we struggle with a lot.
Yeah.
And we look at R squared, and we look at a bunch of different things. But you just never know what's gonna work. Especially it's so tough because a lot of our trades are internalized. It's very tough to really know whether this trade was really good or not.
Yeah.
And we have a bunch of analysis that's done, but it's never accurate, and it's never it's, as I said, it's never exact science. So
attribution is insanely hard to do.
Yeah.
Even in fixed income, when you're calculating, so in case you don't know, what we're talking about here is the contribution to profit and loss from different trades is often very tricky to do in the industry. You have very complicated trades. And I think maybe 60% of the time it's just a rough estimate.
Yeah.
And that's just because it's often very complicated to work out what your profit and loss actually is. Part of the reason is to something called a mark-to-market phenomenon, where if you want to price something that you own, depending on how tricky that asset is or how complicated it is, it's really hard to get a price for it that's a true price representation of it. Kind of a complicated way of going up. I guess another way of thinking about it is if you're Tesco's and you want to find out what the price of your potatoes are in the industry, but it turns out there's only 3 suppliers, it's very hard to know if that's the true price.
Yeah.
And so when you're going mark to market, in other words, if you're trying to figure out what the true price is, figure out what to stick in your Tesco's balance sheet or your profit and loss statements, it gets very complicated if you only have a small number of suppliers or if it's a very complicated product. And so calculating attribution is very hard. That's the point here. Yeah. We're out of questions, but if you have anything you want to talk about, anything you want to wrap up on?
Nothing. It was really nice talking about these things. I don't get to talk a lot about what I do, and have these sort of conversations. So it's really nice. I hope the audience went away with something. They learned something. And if I sort of can wrap up everything that I've sort of spoken about or we've spoken about in the last an hour, and so is that don't be afraid to make failures. Don't be afraid to go out there, test stuff, break stuff. That's all part of the learning process. Go out there, put yourself out there, learn, break, move forward. That's the bottom line. That's what our industry stands for. That's what the tech world stands for, and that's the future. If you're not willing to take risk, you're not learning. You're not putting yourself out there, and you're not gonna make money. If you put yourself out there, you might have bad days, and that's the reason why you need to sort of have protections, and you need to have these stop losses, and make sure that you're not selling your house and putting everything on the line to price these things and make money. But you have to be sensible about it. But you should be afraid to make losses, and that's how you're gonna make make profits.
You learn from your failures. High level takeaway.
Success can be lousy teachers, and failures can be teachers.
That's well put. On that note, thank you for coming.
Thank you so much.
Hope you guys enjoyed it, and I'll see you guys next time.